Welcome back to the show. Let's talk to Jeremy Stretch, the head of G10 FX for CIBC. Morning to you, Jeremy.
Good morning, mate.
Right, we talked off air. I said, what are your high conviction on? You told me you short CAD and you like the Aussie. Let's kick off with the CAD. Why are you thinking bearish thoughts?
Well, I think we've seen an extreme degree of volatility in the course of the last 3 or so months. We obviously saw that run up to the upper 130s back in spring. We saw it all the way come down to almost 120 in the summer or into the autumn because of the gyrations of the Bank of Canada. I think we're still in a scenario now where I think rate spreads are moving against Canada, certainly against the US. We've seen the Canadian bond market outperforming of late, and I think that outperformance has further to run. So I think that does suggest that the Canadian dollar has further downside risks. Markets are still long CAD. I think there is still a need to clear out some of those positions. And as the data moderates into the back end of this year and into the spring, and the Bank of Canada are very much on hold in our view until probably April or May next year, then I think that allows and will see the Canadian dollar underperform.
And in terms of the Aussie, why are you bullish?
Well, the Aussie I think is an interesting one because, again, we've seen a market which has been looking for a degree of appreciation, but we have seen the sort of the market proving to be relatively relaxed about the RBA outlook, and indeed looking at some of the comments from Governor Lowe in the overnight session, he's also not necessarily desperately convinced that the rates spectrum needs to move in the short term, but he is talking about the necessity or the monitoring of wages, and I think that is going to be a factor which is going to come through in the course of the next 3 to 6 months. And so I think the market is possibly underplaying the probability or the possibility that the RBA will be forced to consider a rather earlier tightening than the market's currently discounting. And I think in a world where we're looking for global synchronized growth through the rest of this year and into 2018, then I think as a consequence of that, countries which are open and which are commodity orientated, I think will benefit from that. So I think there's a degree of catch-up from the Aussie's perspective. In the current levels, it does look rather cheap, or certainly much better valued against the US compared to where it has been. So indeed, if you're actually looking at that pair strategy in terms of Aussie CAD, then I think there is scope to say that the Aussie can materially outperform over the course of the next 3 to 6 months.
Brilliant stuff. Thank you very much indeed.